Okay, I think we've got quite a few people online today. Thank you everyone for joining us for our webinar, The Energy Market Volatility, an Insider's Perspective. This session's being recorded, and after the session's finished, what we'll do is we'll send an email out to everybody with a link to the recording along with the slides themselves. The session should last in total about an hour, with about 15 minutes at the end for questions. So if you have any questions, please use the chat module. Julien will run you through how to use that shortly. We'll pick up any questions at the end. If we have a little bit too much to get through, what we'll do is we'll address those questions offline and send them round afterwards with the email that we send. Our presenter today is Julien Waraud. He is head of Energy Scan, which is our customizable digital platform which gathers data on the energy market and is it's dedicated to our professional clients. I'll just hand you over to Julien now to carry on with the presentation. Over to you, Julien.
Hello all. Thank you, Tristan, for this introduction. So today, as mentioned by Tristan, we'll have a look at this global energy crisis in 3 parts. So the target clearly is to give you the keys to understand this crisis. First, looking at the macroeconomic drivers, because what is really key to understand is the fact that what we are living at the moment in the energy market is embedded in a global inflation trend. Of course, in the second part, we'll have a deeper look at this historical gas supply shortage and its impact on global energy prices, especially on power and coal prices. And we'll finish with a focus on the UK energy market with more details on the fundamentals of gas and power markets in the UK. So as mentioned by Tristan, this is an interactive session, so don't hesitate to ask questions in the chat module, and I will try to spare some time between 10 to 15 minutes to answer maximum questions at the end of the session. So let's start with the macroeconomics drivers, and this first slide to show you that clearly we have a mismatch between a strong economic recovery and strong tensions on the supply side. So you can see in the left chart that GDP is back to its pre-crisis level almost everywhere. So we have Q3 2021 figures. So you can see that China is clearly leading the way, as it's the only major economy which did not suffer from a recession last year. But in the euro area, in the US, and also in Northeast Asia, GDP is relatively close to its Q4 19 level. So the trend is clearly on the upside. And if you have a look at the right chart, which is representing the manufacturing output in the main global economies, you can see that, of course, we have a recovery since the middle of last year, but you can see that the trend is not on the upside for the past few months. It's even in the downside in some countries, especially in the biggest industrial countries such as China or Germany, and clearly this is leading to inflationary tensions, and it's linked to several supply issues. So you may have heard about some tensions on raw materials, but if you have a look at also the global trend, especially for delivery times, you can see that these delivery times keep on increasing in Europe and in the US. So you can see it on the left chart. It's based on manufacturing PMIs, and so these PMIs are representing delivery time. So when the figures are around 50, it's a stable delivery time. And when this figure is decreasing, so in the chart, when those numbers are increasing, in fact, are going up, because this is a reverse scale, you can see that delivery times, especially in the euro area, in the US, in the UK, are much longer than a few months ago, and the trend is quite on the upside. And it's based, of course, on many issues, looking at raw materials, but also looking at manpower. And if you look at the right chart, you can see that recruitment difficulties are very strong. So you have figures for the US and the UK. And if you look at this chart on the right, you can see that in the US, for example, 7% of all US jobs are vacancies. So this is extremely high. So you have the chart for the past 20 years. So you can see that we have never been in such a situation. It's the same case in the UK. So the ratio is a bit lower in absolute terms, but it's not exactly computed the same way than in the US. But the trend is clear. You have between 3.5 and 4% of total UK jobs that are vacancies as well. And these are structural drivers that are likely to keep inflation rates structurally higher. And so, of course, if you have a look at inflation rates, you can see that the trend is clearly on the upside. We have rates above 5% year on year in the US for the past few months. And it's not only linked to energy, because if you look at the right chart, where we represent core inflation, so inflation excluding inflation linked to food and energy, you can see that, for example, in the US, this core inflation rate is above 4% year on year, and the trend is clearly on the upside as well. So we can imagine that in the coming months, even if we have a decrease in energy prices, inflation rates are likely to remain high in absolute terms. And so moving on to the energy field, and before we go deeper into details for gas and power markets, just a comment on the oil market, which remains the benchmark of energy prices. And you can see that the trend, the global trend we saw on the global economy is similar at what we are seeing in the oil market, with a mismatch between global oil demand and supply. And clearly, you can see that global oil demand dropped very quickly last year with the COVID crisis and all the lockdown measure, whereas the supply had some difficulties to follow suit. And now oil demand is recovering at a fast pace, even if in absolute terms we are still below our pre-crisis level. But you can see that on the supply side, we are far from satisfying all this demand. And so with such a mismatch, we are drawing heavily on storage. And you can see on the right chart that crude oil stock levels dropped heavily over the past few months. And of course, this is driving oil prices higher. So we are at a 3-year high for the Brent first nearby contract. So it's not really impressive compared to what we see, for example, for gas prices. But this is clearly one of the main trend we have at the moment on almost every commodities, with strong demand and supply issues. So moving on to the second part of this presentation on natural gas markets, I would like to emphasize first on structural drivers before we go much more into details on short-term drivers. If you look at the trend over the past 20 years in the European gas market, you can see that first, on the demand side, it's relatively stable. You can see that we have some variations, of course, linked to the competitiveness of gas versus coal, linked also to the introduction of a CO2 price in Europe over the past 15 years. Also linked to global macroeconomic trends. Of course, you can see that there was a drop in gas demand from the peak of 2010. But overall, gas demand is relatively stable. And if you look at the supply side, the trend is quite clear, because 20 years ago, more than half of total gas demand was satisfied by domestic production across Europe. Now it's only 40%. And so the dependency of the continent on imports has increased dramatically over the past 20 years. And to give you an idea, 20 years ago, countries such as the UK or the Netherlands were net exporters of natural gas. Now they are net importers. And in the UK, for example, around 50% of total gas demand is satisfied by imports. So this is I would say the structural trend in Europe, this growing dependency on imports. And if you look at the Asian market, now, in terms of demand, the trend is clear. It's clearly on the upside, because we have a huge growth on average over the past 20 years at 7.5% on average. So this is extremely high. And if you look at the supply side, you can see that like Europe, most of this growth is fed by imports, and especially LNG imports. And this is really important to understand. Asia and the main Asian economies are really dependent on LNG imports. So, for example, countries such as Japan and South Korea are 100% dependent on LNG imports. They have no pipeline connections, which is not the case for Europe, which is surrounded by pipeline suppliers such as Norway, Russia, or Algeria, for example. And so if you look at short-term drivers, you can see that Asian LNG demand is growing again this year at a huge growth rate at 10% year on year in the first 10 months of 2021. And this is mainly driven by China, which became the first LNG importer of the globe this year, beyond Japan, which used to be the first LNG importer for many years. And the growth in Chinese LNG demand is at 21% year on year in the first 10 months of 2021. This is, of course, extremely high. This is driven by, of course, this economic recovery. We saw it in introduction. GDP growth in China is very strong, and without any recession last year, the absolute level is extremely high. This is driven also by growing gas to power demand, because China is looking at reducing its reliance on coal with a global net zero target for 2060. So LNG demand is growing at a fast pace, and at a faster pace than domestic production in China. So that's why LNG imports in China are growing at such a high pace. And if you look at Europe, we had a very strong first half of the year in terms of gas demand, especially due to a prolonged cold winter in April and May. I don't know if you remember, but April and May were really cold, especially April. So in France, April 21 was the coldest months for the past 20 years for April. So this was significant in terms of gas demand, and you can really see it in the chart. And then in the second half of the year, you can see that gas demand is below the average level of the past few years. And clearly, this is linked to this extremely high gas prices, which led to significant demand destruction. first in the power generation sector, and secondly in the industrial sector. So if you look at gas and coal-fired power generation over the past few months, you can see here on the left chart that gas-fired power generation was relatively high in the beginning of 2021, and then dropped significantly compared to 2019 and 2020. Even if it rebounded in September, but this was due mainly to a lack of wind power generation, especially in the UK. And then on the continent, this sudden drop in gas-fired power generation benefited to coal-fired plants. And you can see that coal-fired generation increased significantly over the past few months. But in absolute terms, it's still well below the levels we observed over the past few years, notably as a certain amount of coal plants have been mothballed or just retired due to high production cost or environmental issues. And then if we have a look at the European gas supply side, so as I mentioned at the beginning of this second part, Europe is relying more and more on imports because its domestic production is structurally decreasing, especially because we don't invest in a new upstream capacities in Europe. So we rely mostly on pipeline imports from Norway, North Africa, and Russia, and also LNG imports. So if you look at those two charts representing Norwegian pipe gas exports and North Africa, so Algeria plus Libya, pipe gas exports to Europe, you can see that these supply sources are pretty much maxed out. So even if Equinor, the Norwegian gas producer, indicated that it was willing to increase its production level by 2 BCM this winter, in fact, the production is already at its maximum level. And you can see that in October, it was at record highs for this time of year. So we are already at the maximum we can import from Norway. North Africa is also at very high levels, especially because most of this supply is oil index, and we will see it later, but oil index gas prices are very competitive at the moment compared to the spot market. So that's why this import source is maxed out at the moment, even if recently you may have heard about the diplomatic crisis between Algeria and Morocco, which led to a cut in Algerian pipeline exports to Spain through the Maghreb pipeline. But overall, Algerian gas exports to Europe are close to historical highs for this time of year. And of course, we have to talk about Russian gas. And if you look at Russian gas flows to Western Europe, so this is Russian gas flows coming through Europe through 3 roads, which are Nord Stream 1, which is directly connecting Russia with Germany through the Baltic Sea. So if you look at the map on the right part of the slide, you can see Nord Stream on the top of the map. We also took flows through the Yamal-Europe pipeline, so through Belarus and Poland directly to Germany, and also flows through Ukraine, through the Brotherhood pipeline, coming out at the Ukrainian and Slovakian border at Velké Kapusany. And so if you look at this aggregated flows, you can see that we are in a downward trend in terms of Russian gas supply, and October was really low compared to previous years. So, of course, the key question is why these Russian gas flows are so low in 2021. So there are several elements to consider. First, if you look at the Russian gas market, you will understand that looking at Gazprom figures, stock levels in Russia were very low at the end of the winter period. And so Gazprom had to refill these Russian storages in priority, because this is its mission to supply the Russian gas market. Then you can see also that in the map that Russia is also supplying Turkey through two pipelines, which are Blue Stream and Turk Stream, which was delivered last year. And Turkish gas demand for Russian gas is really strong at the moment. This is one of the main customer of Gazprom. The supply contracts are oil index, so of course they are competitive compared to the spot market. So Gazprom has also to supply Turkey, and the strategy this year, looking at Gazprom supply to Europe, is to serve long-term supply contracts first. And that's why there is no long-term customer of Gazprom in Western Europe, which reported any supply default at the moment, because these long-term contracts are honored. But Gazprom used to sell a certain amount of natural gas directly on the spot markets or through an electronic platform, which is called the ESP, which is dedicated to Gazprom spot sales in Europe, mainly in Central Europe and Germany. And these spot sales volumes are dropped significantly over the past few months, and that's why we are seeing much lower Russian gas volumes at the moment. And of course, we have a background story, which is Nord Stream 2, which is which could flow natural gas through the same road than Nord Stream 1. So the pipeline today, which has 55 BCM capacity per year, which is the same capacity of Nord Stream 1, is technically completed, but is waiting for regulatory clearance from the German energy regulator in the first step, and the second step from the EU Commission. So clearly, these regulatory discussions are really uncertain in terms of outcome. What you have to remind is that the next deadline is on the 8th of January 2022. This is the deadline for the German energy regulator for providing its draft decision on the regulatory status of Nord Stream 2 to the EU Commission. So clearly, the issue is linked to the unbundling of the pipeline, so the separation between ownership of the pipeline and gas supply. And so Gazprom asked for an exemption, because normally with EU rules, a company cannot own a pipeline and operate it and flow gas through it at the same time. You have to have separated companies. And so Gazprom got an exemption for Nord Stream 1, that was 10 years ago. And Gazprom asked for a second exemption for Nord Stream 2 and did not get it yet. And it's not sure that Gazprom will get this exemption the second time. So that's what is at stake at the moment for Russian gas. But Europe could also get more LNG to cope with this supply shortage. And you can see that recently, this is the orange line here on European energy imports. You can see that recently European energy imports reach very high levels, but they also reach relatively low levels compared to the past 2 years during the summer period, notably because Asian energy demand was extremely strong especially for restocking issues in countries such as Japan or South Korea, which are heavily dependent on the LNG market. And so the competition for energy supply is really fierce at the moment. And you can see that most of what we call the flexible LNG volumes, so the volumes that may not have some destination clauses, so for example, US LNG exports, you can see that these volumes went mostly to Asia and South America, looking at US LNG exports. So I just computed some figures, and since the beginning of 2021, 50% of US LNG volumes went to Asia, 20% to South America, and the remaining 30% to Europe. So you can see that Europe is not the first destination for US LNG volumes. It's not the first destination as well for Qatari LNG volumes, and it's for a very simple reason, which is that Asian energy prices used to trade at a premium to Europe gas prices. So clearly, if you look at the blue line here, which is the Asian spot energy benchmark, it's pretty much always trading above the orange line, which is the TTF front month contract. And so that's why Europe is facing strong difficulties at the moment to get extra LNG. So with the peak we recorded over the past few weeks, we got more LNG. This is what I mentioned here in this slide. So this jump in LNG imports over the past few weeks is clearly linked to the jump in European gas prices, and the fact that shipping rates were relatively low, but these shipping rates increased significantly over the past few weeks. So we are not sure that this increase in LNG imports will last in this winter. It should be much more temporary because the peak winter period in Asia is about to start, and probably most of flexible LNG volumes will go back to Asia in the coming weeks. So overall, if you sum all these elements, we have one main issue in Europe, which is the main source of volatility at the moment, is the fact that gas stock levels are at all-time lows for this time of year. We have a deficit compared to the 5-year average, which is around 15 BCM. So this is significant, and of course, this is the main concern for European gas market players at the moment. And if you look more into details on this storage deficit, and if you zoom on stock levels at European sites where Gazprom holds capacity, you can see that the deficit is significant here. It's around 50% of the total European storage deficit. And of course, this is one of the main attention points at the moment. And if you remember what I said regarding Russian gas exports, I mentioned that Russian gas stock levels were very low at the beginning of the summer period in 2021. So clearly, Gazprom prioritized the filling of Russian sites first, and that's why you can see here that stock levels were relatively stable over the summer period, whereas in the past they used to increase significantly. They started to increase only at the beginning of September, and we'll talk about that in 2 slides. Last week, Vladimir Putin stated that Gazprom was due to send more gas to fill European storages from the 8th of November. So that's why European gas prices dropped heavily at the end of last week. And this is the main element, the main attention point for the coming days on European gas markets, how and when Gazprom will start to fill these stock levels before the end of for the start of Q1 22, which is the peak winter period for natural gas demand across Europe. And so, of course, if you have a look at prices now, and if you have a look at prices since the beginning of the year, and if you look at the main energy benchmarks, you can see that gas is clearly leading the way, but it's leading the way from July, in fact. At the beginning of the year, the bullish trend was clearly located in Brent and CO2 prices. And CO2 prices were really strong at the beginning of the year in anticipation of mostly on the Fit to 55 package with this new CO2 reduction target at 55% of 1990 levels by 2030. So this had a strong impact on CO2 prices. But since the release of this package in mid-July, EUA prices are more or less stable. Brent prices increased significantly, but clearly, if you look at these figures in base 100 on the 1st of January, you can see that the increase in Brent prices is much more limited than what we had on natural gas, power, and coal prices. And clearly, we are in the middle of what I can call a global energy supply battle. Even at some point, we could have talked about a global energy war. In fact, especially at the beginning of October, in the 1st of October, Chinese officials ordered top energy firms to secure supply at any cost. And we started to see some headlines describing meetings at Chinese utilities using really a war vocabulary. And this of course, has led to a sharp increase in volatility and concerns about global energy supply. But overall, if you look at the succession of events over the past few months, you can see that the trend clearly accelerated at the end of October and the beginning of September, with a first event, which was the fire at the power interconnector between the UK and France. And then we started to see the first evidence of industrial gas demand cut in the UK with the CF Industries. And then this stories about Russian gas and the fact that Gazprom was reducing its transport capacity through Poland, notably from October. But then in red, you can see that we recently had some bearish elements. So I mentioned the statement of Vladimir Putin regarding European storage filling, but we did not talk about coal, and coal prices were extremely high as well over the past few weeks. And then China decided to intervene to bring coal prices in a reasonable range. And clearly, this has led to a sharp drop in coal prices, which fed into gas and power prices over the past few weeks as well. So I think it's time to move on to the last part of this session, looking at UK energy markets. And so first on the UK gas market, such as Europe, the UK is more and more dependent on imports for natural gas. And what is clear is that these imports are seasonal as well. And you see that these imports are really high for the winter peak. And so you have imports mainly from Norway and from energy suppliers, but you have also imports here from interconnection with the continent, with net imports, especially in January, when gas heating demand is very strong in the UK, and that's one of the specific points of the UK gas market. The second one is the lack of storage capacity, notably since the closure of the rough storage sites in 2017, which used to represent around 70% of total UK storage capacity. And now only 2% of total UK gas demand is stored underground. If you add LNG inventories, you have an additional 1.5% of UK gas demand. So it's 3.5% of UK gas demand, which is stored through LNG or underground sites. But it's really low, in fact. If you look at France, for example, underground inventories represent 26% of total gas demand. And of course, this is a source of volatility for NBP prices, because 70% of total gas demand in the UK is for heating purposes. So clearly, with a peak during the winter period. And if you switch to the UK power market, what is clear as well is the dependency on natural gas for power generation, which represent almost half of total power generation in the UK. There is a growing dependency on wind power generation as well, and on imports. And this trend is likely to continue, notably because we will have more coal and nuclear closures in the coming years. And just to focus on imports, in August 21, power imports in the UK represented 15% of total UK power supply, which is really significant. And this is why in the coming years, so as I mentioned, we will have a certain number of coal and nuclear plants which are due to exit the market in the coming months. And we have a deadline for remaining coal capacities in September 24. But in parallel, interconnection capacity is about to grow significantly, with 3.8 gigawatts of additional interconnection capacity from January 22 until January 24, with interconnections expected from Norway, France, and Denmark. And so these characteristics of the UK power market explain why we had such high spot power prices in September. First, because we had a very low wind power generation, especially in the first half of September. So overall, you can see here that UK wind power generation was around the 5-year average in September. It jumped significantly in October. And so that's why you can see here that spot power prices in the UK were extremely high in September. They dropped, even if you still have very strong volatility in October. And then you can see here that we had a very strong drop in power prices, which is clearly linked to the drop in gas prices after the statement of Vladimir Putin regarding European storage sites. And now prices went up strongly because wind power generation is relatively low this week, with relatively cold temperatures as well. So don't hesitate to ask your questions in the chat module through the messaging tool. And then, yeah, moving back to the presentation, looking at the curve, skyrocketing clean fuel costs. So clean fuel costs, these are the production costs for CCGTs and coal-fired plants, taking into account the price of CO2. And you can see that the correlation between the UK baseload Cal 22 contract, for example, here is very strong with these clean coal costs. And that explains why we had such high prices in September, notably. And then we have a downward trend over the past few weeks, notably in anticipation of an increase in Russian gas supplies in coming weeks. But if you look at the forward curve, you may have noticed that it's heavily backwardated. So we have very strong difference between the Q1 22 prices at the NBP and the Q2 22, but we also have very strong differences between the Cal 22 and the Cal 24. So at the moment, the NBP Cal 24 contract is trading twice lower than the Cal 22 contract at 65 pence per term. I think that it's not fundamentally justified, such a difference. So that's why we see some opportunities clearly in the forward curve, because fundamentally the situation is not likely to be much more comfortable in 2024, and we think that these prices are relatively discounted compared to which level they could trade at delivery. So this is the kind of opportunities you have at the moment. This backwardation is offering some interesting trades, especially on the forward curve at the moment. And to conclude, one word on the UKA market, which started in May 21. So it started to be relatively correlated to the EU market, and then in mid-September we noticed a very strong upward move in UKA prices. But we believe that it was linked to the fire at the UK French power interconnector, which supported expectations of a higher thermal generation, mostly from coal and natural gas. But you can see that this premium is clearly reduced, and we tend to think that the UK market is still at its early stages with no surplus, which is we still have a very huge surplus of EUA quotas in Europe, which are limiting the upward trend. It is not the case in the UK, which started the market with zero surplus. And of course, in terms of liquidity, in terms of number of factors, it's much more limited in the UK compared to the EUA market. So that's also explaining why we still have a premium between the UKA and the EUA market. So it's time to conclude with some key takeaways. And first, of course, on the European gas market, which is the main source of volatility and price growth at the moment, we believe that this market could loosen, but at two conditions. If Russian pipe gas supply increases next week, as suggested by Vladimir Putin last statement. So watch out for the 8th of November and probably or not increase in Russian gas supply to Europe to fill storages. But Europe can also get more LNG cargoes in the coming weeks. It will depend, of course, on Asian LNG demand, so on Asian LNG Asian temperatures, but also the intensity of the economic recovery. We saw some slowdown in China, notably due to a lack of coal-fired power in the industry. And we also can have a mild winter, which will limit gas for heating demand across Europe. But overall, the fact that stock levels are very low, this remains a major source of volatility until the end of the winter period, because clearly the physical risk is not in the short term, but much more at the end of the winter period if stocks are very low. For next year, clearly the startup of the Nordstrom 2 pipeline is the main element explaining the current backwardation we are observing in the NBP curve, for example. So clearly, if this pipeline starts at some point, it could trigger a downward correction in global gas prices. But the outcome of the ongoing regulatory talks is still very uncertain, and the next deadline is on the 8th of January 22 for the German energy regulator draft decision. And on power prices, Of course, if gas prices start to drop, power prices will follow suit. But overall, in the UK, supply margins are very thin, and especially in case of low wind power generation and strong demand. So expect the continuation of strong volatility, especially at the spot level for UK power prices. Okay, so that's all for me. I think we can take some questions.
We've had some questions through. First of all, apologies to anyone who's had troubles logging in and getting the sound working. We've had some technical problems. We'll be sending the recording out, as I said earlier, along with the slides, so you'll be able to see the entirety there. Questions we've received. First one from Mark Gamble. So effectively, we have no UK capacity to store gas in cheap periods yet, as a nation have 50% plus requirement of gas for our generation requirements. So will we be forever open to volatile spot prices until gas generation is lower?
That's a good summary, of course, of the UK situation. Yeah, this lack of storage capacity is clearly an issue, and you can see that what is interesting is that in the summer period, the gas surplus is exported to the continent, whereas in the winter period, clearly flows are coming back to the UK. So I don't know how long it will last, but batteries could be a solution for the UK power market to have more storage capacities. I'm not sure that we will have a significant development in this field in I would say quickly, but in the coming years, this could be a really interesting solution to limit the volatility in UK power prices, especially.
The next question we've got is from Stephen. If Nordstrom 2 is not approved in Q1, what do you see the gas prices doing in Q2?
Probably we will have an upward trend in Q2 prices because, but it will depend, in fact, on the absolute level of storages. Q2 prices are clearly discounted because I think the market consensus is a start of Nord Stream 2 at some point in Q1 or in Q2. But if Nord Stream 2 is delayed again later in 2022 and we have low stock levels, clearly we will have higher prices at delivery in Q2. That's clearly a possibility. But it will also depend on the energy market. We will have some additional volumes from the US in the coming weeks, but I don't think it will really ease the situation if we continue to have limited flows from Russia.
Thanks, Julien. Next one from Mark again is if we have similar lines to the last question, actually, if we have a bad cold winter and a second cold April in 22 and May 22, as we did this year, and the fact that the domestic price cap still isn't resolved, how long could we see high prices into Q2 for 2022?
Yes. Yeah, pretty much the same answer. It will depend on the stock level. But yeah, if we have a very cold winter period with no additional flows from Russia and no significant demand destruction in the industry, yeah, clearly we will have some kind of physical issue at the end of the winter period with very, very low stock levels. Mm-hmm. So yeah, this is clearly I would say a worst case scenario. Mm-hmm. But yeah, of course, this could drive Q2 22 prices higher.
Okay. Next question is relating to Russia, actually. If Gazprom have to separate pipe ownership from supply, will this stop Russia restricting our supply?
It's a good question, but it's quite impossible to to answer. This unbundling issue is key regarding this regulatory talks. At this point, I don't have specific elements to share. I don't know exactly what could be the solution to start Nord Stream 2 without an exemption of this unbundling rule. Gazprom, if Gazprom needs to increase supply, it can also it still can book additional capacity through Poland and Ukraine, but this is not the strategy at the moment. Looking at this ongoing regulatory talks, what I can say is that the German Ministry of Economy recently stated that Nord Stream 2 was not an issue in terms of security of supply. So this was an element it had to share with the German energy regulator. So we'll see what will happen. It's also possible to start flowing Nord Stream 2 without regulatory, I would say, validation, but it's not the scenario which is privileged at the moment. But in the history of European gas infrastructure, some infrastructure used to be used before the regulatory clearance. So that's also a possibility, but the German energy regulator stated that Gazprom could face some penalties in that situation. So yeah, it's really open, and at the moment, it's I would say it's more on the ends of the German energy regulator and the EU Commission to find a solution or not to launch this pipeline.
Next question. With talk of the Rough facility being reopened, how long would it take to see any benefit of this if it actually happens? This seems like a medium-term solution instead of the here and now.
Yeah, I think it should not be a very short-term solution because I think the facility is empty. So you will have to fill it, to use it, and then it was shut down because of safety issues because this was a very old infrastructure. So I don't know if it's really possible to reopen it and to reoperate it in the coming months. But clearly, this won't solve the supply issue we have for the coming weeks.
Okay. One last question. If anybody's got any more questions, do get in there now. We've got a bit less than 5 minutes left before the end of the session. Last question I've got here, it's similar to what we were asked earlier actually. Is the French underground gas storage entirely privately financed, or does it receive government support, given the UK government refused to give support to Rough to stay open?
Most of the French underground storage sites are operated by a company called Storengy, which is owned by Engie and also the French government, the French state, sorry. But the difference between the UK and France, and for example between Germany and France, is the fact that gas suppliers in France have storage obligations. They have to store a certain amount of gas regarding their commercial portfolio, and this is we have the same kind of storage obligation in Italy. And if you look at stock levels in France and Italy, they are really good because of these storage obligations for suppliers. And if you look at Germany, for example, or Netherlands, where there is no obligations for energy suppliers to store natural gas, stock levels are much lower. And that's mainly because the spread between summer 21 and winter 21 prices used to be very low over the past few months. So no I would say financial incentive to inject in these countries. Whereas in France, no matter what the the summer-winter spread is, you have to inject to respect your obligation.
Great. Okay. Thank you for that, Julien. I think that's the last question we have today. I think we can call it a day there. Again, apologies for the technical issues that we faced earlier. The recording will be sent around afterwards along with the slides. And if you do have any other questions, do send me an email. I'll be emailing you directly. Thank you very much, Julien, for your time. Excellent presentation. Really interesting to find out how the global situation impacts us here just in the UK, and the fact that it's not just the UK that's impacted by these high prices. And thank you very much, everybody. I hope you have a good rest of the day, and we'll catch up soon. Thank you. Bye-bye.
Thanks for your attention. Bye.